You ever look at a huge, successful company and just wonder, what is really going on under the hood? Well, today, we're handing you the stethoscope. We're going to learn the secret language of business that lets you check a company's vital signs and see if it's actually as healthy as it looks.
You know, a company might look successful. It's got flashy ads, busy stores, the whole shebang. But is it truly thriving, or is it just barely hanging on? To figure that out, we've got to look a lot deeper.
And that's where this idea comes in. Just think of financial accounting as a complete health check for a company. It's a systematic way to look at its vital signs, diagnose its condition, and really understand its overall health.
Okay, so before any checkup, right, you need to understand two things. Who's the patient, and what are the rules the doctor has to follow to give an honest diagnosis? And that's exactly where we're going to start.
First up, who exactly is our patient? Because businesses come in a few different shapes and sizes. You've got your sole proprietorship, which is just one owner. Then there's a partnership with multiple owners. And then you have the corporation, which is treated as its own separate legal person, totally distinct from its owners. And believe me, that structure really matters.
Now, corporations, they have this unique little condition you got to know about. It's called double taxation. Since the business is its own legal entity, its profits get taxed once. Then, when that money gets paid out to the owners, ouch, it gets taxed again. That's a super important detail in their financial story.
So how do we know this whole diagnosis is legit? Well, just like a doctor takes an oath, there are rules in place here too. GAAP, that's the rulebook everyone follows. The SEC is like the medical board protecting investors, and SOX is a law that was passed to make absolutely sure the reports are accurate and to prevent fraud. These rules make the whole thing trustworthy.
All right, so now that we know the rules of the game, it's time to get to the heart of it all, the company's financial DNA.
This equation right here is the absolute master key. Seriously, it's the simple, kind of beautiful formula that explains, well, everything in business finance. It means everything a company has is perfectly balanced by what it owes to others, plus what the owners actually have a claim to.
So let's crack this open. First up, assets. This is all the stuff the company owns. Think of it as all the tools it has to make money. The cash in the bank, the products on the shelf, the computers, the factory, all of it.
Okay, so you've got all that stuff, but how did you get it? That's where liabilities come in. This is everything the company owes to other people. It's the bank loan for that factory, or the money you still owe your supplier for those products on the shelf.
And finally, after you pay off everything you owe, what's left over? That's equity. It's the owner's slice of the pie, their actual stake in the business. So you see, all the stuff you own is paid for by either borrowing money or by the owner's investment. It all has to balance.
Okay, we've got the DNA down. Now it's time for the actual physical exam. This is how all the company's day-to-day activities get recorded and turned into those official health reports we've been talking about.
The whole system works because of this one kind of genius idea: double entry accounting. Think of it like a perfectly balanced scale. For every single transaction, an entry on one side, a debit, has to have an equal entry on the other side, a credit. This simple trick makes sure that our core DNA equation, assets equals liabilities plus equity, always stays in perfect balance.
Let's make this real for a second. Look at this example. If a company buys supplies but doesn't pay cash right away, its supplies asset goes up, and its accounts payable liability, what it owes, goes up by the exact same amount. One debit, one credit. See? The scales stay balanced. Every single transaction works this way.
So all those transactions get rolled up into the first of our big health reports, the income statement. You might also hear it called the P&L. I want you to think of this one like a movie. It shows you everything that happened over a period of time, say 3 months or a year, and tells you if the company ultimately made a profit or took a loss. And our second major report? That's the balance sheet. Now, if the income statement was the movie, the balance sheet is just a single snapshot, a photo, maybe even an X-ray. It freezes one specific moment in time and shows you exactly what the company owns and what it owes on that single day.
And what do you think we find on this balance sheet? You got it, assets, liabilities, and equity. This report is basically that fundamental DNA equation we talked about, just blown up with all the details. It's the full financial readout.
All right, the lab results are in, we've got the reports. Now comes the fun part. We get to be the doctor and actually read the results. We're going to look at a few key numbers, the vital signs, that tell us what's really going on with the company's health.
First thing we're checking are the profitability ratios. These are just quick little calculations that tell us, hey, is this company actually any good at making money from what it's doing? It's literally like checking the company's pulse to see how strong it is.
And a big one you'll always hear about is ROI, or return on investment. It answers a really simple but super important question. For every dollar I put into this business, how many cents of profit am I getting back out? It's a fantastic measure of efficiency.
Okay, next vital sign, liquidity ratios. Now, this isn't about long-term profit. This is about survival, right now, today. Does the company have enough cash on hand to pay the bills that are due, like, next week? It's a critical stress test.
And the go-to test for this is the current ratio. It's super simple. You just compare the company's assets that it can turn into cash quickly against the bills it has to pay soon. This tells you if it's in a safe spot or if it might be heading for trouble. A very, very important vital sign.
So, what's the big takeaway from all this? The most important thing to remember is that these financial statements, they aren't just boring numbers on a page. They really do tell a story about a company's big wins, its tough challenges, and where it might be headed next.
And the best part is, you now have the Decoder Ring. You have the basic tools to start reading that story for any company out there. So, I've only got one question left for you. What company's health will you check first?